In this week's video, by reviewing hard and unbiased evidence, we'll answer the question, how much progress are the bears making? In this week's video, we'll take one of the most useful and easy to understand ratios used in the CCM market model to compare the present day to a bullish period in 2006 and a bearish period in 2008. We'll close with this summary table, which allows us to take all of the concepts and bring them back to the present day. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Before we review how this chart and the market model were helpful in terms of managing downside risk in 2008, let's switch back to the 2013 chart and explain the basic concepts. This is a weekly chart used in the CCM market model. If you're new to the fold, this looks busy and somewhat intimidating. It's very easy to understand if we walk through it piece by piece. We're looking at a weekly chart. Helps us answer the question, would I rather be long or would I rather be short? Would I rather be long or would I rather be short is a powerful question. This chart tells us a lot about the market's risk tolerance, and it tells us a lot about opportunity cost, which is extremely important in investing. When the ratio of the S&P 500 or the SPY ETF relative to the SH ETF, which is shorting the S&P 500, when the ratio rises, that's what risk on looks like. In periods like this, you want to be in stocks, overweighted in growth assets, and underweighted in defensive assets. When the ratio looks like this, we prefer to be overweighted in defensive assets and underweighted in growth assets, such as stocks. This is the ratio here. This is a moving average here in blue and another moving average here in red. We use the moving averages to help us discern between volatility to ignore. Here, the market moves higher. S&P 500 is down here below. And volatility to respect, where the markets move lower and defensive action is required. A bullish look, price above, both moving averages, blue above red, slopes up. That's what risk on looks like. The mirror image here is what risk off looks like. Slopes down, blue below red, price below both. Before we review the 2013 version of the same chart in detail, if we review a bearish period in 2008 and look at a bullish period in 2006, it will help put some context from a risk-reward perspective around the present day. This is the same chart we just looked at, risk on versus risk off, long versus short. This is early 2008. This is late 2008. This is our ratio here. These are our moving averages in blue and red. Where the cursor is, this is the S&P 500 index here. The point of the exercise, will this ratio help us avoid large losses? The answer is a definitive yes, because mathematically during a correction or a bear market, long versus short has to react to negative developments. Here you can see we got our bearish moving average crossover. We have a full bore bearish look here in May of 2008. Draw the line down from where we have the full bore bearish look. The S&P 500 was at 1395. It dropped 12%. The whole time we have a bearish look that tells us to remain defensive. Once this line starts to rise here, we're moving towards more of a neutral look. And then here we switch over to more of a bullish bias with our bullish moving average crossover. And notice in this period here, When the market model started to improve, looking at this one ratio in isolation, the S&P then moved from 1233 to 1292. Here we get another bearish moving average crossover, the observable evidence. I don't need to forecast anything. I can see this on a chart before all of this happens. I can see this on a chart and record it in the market model, answering binary yes or no and unbiased questions. I can see all of that before this big decline takes place in the S&P 500 index. We get our bearish look here. The S&P 500 drops from 1292 to 800. So the market model, bearish look, helps us avoid or begin to step away from risk during a 12% loss here and a 38% loss from here to here. Notice the whole time we're dropping from 1292 to 800. The observable evidence never switches back to neutral or bullish. With central bankers all over the globe, including the major central bankers in Japan, Europe, and the United States, printing money in a simultaneous manner that we've probably never seen before in our lifetimes, at some point we'll have a problem. It's inevitable that we'll have a crisis. You have to ask yourself, how will I manage through that? We know how we'll manage through it. We'll answer binary and unbiased questions. Now, do we believe something like this is imminent? No, we don't, but we don't particularly know when that will come, and it doesn't matter. And again, the emphasis is we don't need to know when it's coming. If we just pay attention to the observable evidence, the model will have us reduce risk and step aside. If we look at the other end of the spectrum, it's clear here that the model and this ratio can help us manage risk. Is it clear that it can help us participate in markets that are gaining in the event that we do get a bubble and the S&P 500 continues to gain for 6 months or another 3 years? Taking the same concepts back to 2006, the only difference here is we're using a mutual fund instead of SH in this area. SH didn't exist here, so this is an excellent proxy and correlates very strongly and zigs and zags when SH does. Point of the exercise: can the model in this ratio, the reason why we say can the model, the examples that we're using here and the concepts of observable evidence and trend following apply across numerous markets and ratios that are used within the CCM market model. So if you understand these concepts, when we get to the summary table, we use similar concepts on all of those other ratios and or markets. It's easy to see here what trend following is all about. We're in a downtrend here. The model helps us discern between volatility to ignore. This is somewhat of a dead cat bounce. Volatility to ignore. We don't get the full bullish moving average crossover, so I'm discerning between volatility to ignore and volatility I should respect. Why? Now we have a bullish moving average crossover. Now we're in a bullish state here. This is a full bore bullish look that we have here. Now I'm discerning between volatility to ignore, volatility to ignore, volatility to ignore, ignore, ignore. It helps me stay with the uptrend. If we get to a look like this, this isn't volatility to ignore. This is volatility that requires action. So you can see here in 2006, we get the bullish look here, and it stays bullish all the way up to this point here, showing us that the concepts and the observable evidence, and again, there's no forecasting needed. We're human beings. We all want to know what's going to happen next. Here is a bullish look, observable evidence that precedes a massive gain in the S&P 500 index. Here's observable evidence that we can see here on a chart that precedes losses in the S&P 500 index. During this period where the model says we're in risk on, the S&P 500 moved from 1236, this is the S&P 500 here, where my cursor is, to 1448, which was a 17% gain. Now let's take the concepts from 2008 and 2006 and apply them to the present day. You'll notice prior to bad things happening in the ratio and bad things happening in the stock market, we tend to get some consolidation or sideways movement in the ratio prior to the S&P 500 dropping here where my cursor is. S&P 500 drops, we have some sideways movement and consolidation. This is a weekly chart, so this is several weeks here prior to the declines. And we have some consolidation here. We don't make a higher high, and we come down. Let's compare that to the present day. That's not what we have today. Notice if I drew a line here, the slope of it would be horizontal. The slope of it would be horizontal and horizontal. If I draw a line here, we are getting some consolidation, but the bias in this consolidation is bullish as the market and ratios are sloping up. Williams percent R here measures momentum. We can think of momentum as somewhat of a gauge or a way to read the battle between bullish economic conviction and bearish economic conviction. When we're above negative 20, bullish economic conviction is clearly dominating relative to bearish economic conviction. You can see momentum or conviction here is strong. The stock market does quite well. Momentum in here is not very strong. It's somewhat indecisive, and we get a pullback. Point of the exercise now from a twofold perspective. Good things tend to happen when momentum is in overbought territory or above negative 20. Above, good things tend to happen in the stock market. Above, good things tend to happen in the stock market. The probability of bad things happening increases when you start to drop out of overbought, as we did here. Bad things happen. This momentum indicator is tied to the ratio of long versus short. The S&P 500 is here strictly as a reference point. We fall out of overbought territory, the probability of bad things happening increases. Fall out of overbought, bad things happen. In the present day, we still have a relatively strong momentum presence when we look at the battle between bullish economic conviction and bearish economic conviction. We have not dropped below negative 20. That may happen next week, but until it happens, it tells us to be somewhat patient with this ratio and with the stock market in general. Another takeaway, we get a decline here in the ratio, decline in the stock market, decline in the ratio, decline in the stock market, decline in the ratio, decline in the stock market. Some tendencies, as you would expect. Prior to a decline, the battle between bullish economic conviction and bearish economic conviction, which is the market's pricing mechanism and what determines the value of our portfolios, we would guess that it would be relatively tentative here, here, and here. That's exactly what we get. We get a short momentum spike and more of a tentative look here. Compare the bullish economic conviction here relative to here. So we get a short spike up, decline in the stock market. Short spike up, decline in the stock market. Relatively short triangle, a spike here with E, and a decline. That's not what we have in the present day. Everything that we've said here speaks to probabilities and tendencies. Can we get outlier events? Sure we can, but there's one thing that we do know about the importance of this chart. And listen to this carefully. It's mathematically impossible for this chart to miss a correction in the stock market or a major bear market. It's mathematically impossible. And if you think about it, it's true. We're looking at the ratio of being long versus short. During a correction, this ratio has to decline. During a risk-on period, it must rise from a mathematical perspective. And thus, that's why this chart carries a heavy weight in the CCM market model and has a very high correlation to the stock market. So heading into next week, we'll keep an open mind. But to morph from this clearly bullish look to this clearly bearish look, you'll see typically that takes some time. We move from here to here, but that takes several weeks. We move from here to here, that takes several weeks. This is a very long consolidation process, throwing up yellow flags prior to this waterfall decline. So even under the worst case scenario conditions, if we were to get a multi-week correction, probably will take some time to have this chart morph from this look to a look more like this, or declines in the S&P 500 index followed. Before we close the video with the summary table that summarizes the present day look of the markets in 2013, it's important to understand what we're looking at in that table. This is the same ratio we've been talking about in the whole video. This is the chart list that we use to answer the binary yes or no questions. It's not just this chart. This portion of the model, which is just one portion of the model, uses all of these charts. We answer binary questions. Is price above? Is price below? Slope up, slope down, blue above red, blue below red, etc. And we also answer either binary questions or we enter in mathematical levels so we can take a look at the market from an unbiased perspective. So it's not just price and moving averages, although they carry the heaviest weight. We also use indicators on every one of those charts, and we answer questions about the indicators, or we look at levels for the indicators as well. All unbiased information that allows us to take a reasonable look at the markets and make decisions based upon observable evidence rather than the emotions of greed and fear. As we've seen during the video, there's no question that these concepts are helpful relative to helping us manage risk, participate in rallies, and reduce risk during periods where the odds are against us. How do we keep track of all this? Here's the spreadsheet. We're answering binary questions, zeros or ones, no bias. And we also look at hard data. Then the model, you can see this is a massive spreadsheet that goes down here, takes all of this information, weights it properly. Each chart is weighted differently, and each indicator and each answer is weighted differently. And then what it does is it produces these scores here that we'll review next. It also allows us to take all of these scores and all of that information from all of the charts and all of the indicators and boil it down to one score. So we've taken a massive amount of information, moved it down to one number between 0 and 100 that allows us to compare the present day to historical periods that were either bullish or bearish. This table here shows a summary of the present day market. We're looking at a summary table for the correlation model. So you may ask, are you showing me the whole market model? No, we're showing you a small portion of the market model. This is from the correlation model. There's 1, 2, 3, 4 other models that go into our final allocation, and we'll show you that spreadsheet before we close today. What this tells us is, as of the close on Friday, November 1st, based upon the observable evidence, so price, moving averages, indicators, hard data relative to levels, so where is RSI on a weekly chart? As of the close on Friday, on a weekly chart relative to our time frames, which are longer term, a trader who's trading 60-minute charts may not agree with this assessment, but this assessment aligns with our time frames, which are longer term. This tells us that 99% of the answers or observable evidence on the chart of the S&P 500 in this model, and the correlation model is the one that has the highest correlation to stock prices, and it's why we use it in the videos. It gives us the best read on the current health of the market from the shortest time frame relative to our longer time frames. 99% of the answers are coming back bullish for this chart. Long versus short, which is the one we focused on in this video, 97% of the answers based upon observable and hard evidence coming back bullish, only 3% bearish, 1% bearish. Tells us something has to change for the stock market bears, and it may. It may begin to change next week. We do have cracks that we're seeing, but the cracks, the way this table is sorted is price is obviously the most relevant. So the weekly chart of the S&P 500 from a common sense perspective is the most important. This is the least important chart. Why? It's the least helpful. If I want to track the S&P 500, this is the most helpful. This is second most helpful. These are much less helpful than these. So what is that telling us? It tells us that the charts that are tied to the most important ratios and indicators based upon those ratios or markets are still firmly in the bullish column in terms of observable evidence. So if I look at these here in dark green, the average of these numbers is 94%. The median of these numbers is 96%. If I move even higher on the food chain, beginning with the QQQs and move up, so charts that are even more important than these, the numbers improve even more. From here to here, the average score is a 96, and the median is firmly in the bullish camp at 97. If I take a broader brush stroke and I start to move down towards the cracks, so you can see here, credit spreads, junk bonds relative to treasuries, only 52% of the answers are coming back bullish. Small caps have been weak lately, 65%. Financials have been a little bit weak, 70%. But you'll notice those are on the bottom end of the table. These cracks here may start to move up this chart. The more deterioration we see here, the more meaningful it becomes. Markets can continue to rise when we get orange or yellow flags in this area, and that's why these charts carry a much, much lower weight in the correlation model than these charts. So if we look at the full spectrum of the charts in the model, these are unweighted scores. This is just a simple average, and that's not the way the model works. Just doing this for illustrative purposes. The model is based upon weighted averages based upon their importance. 71% is the average of these numbers here where I'm moving my cursor, all of them. And the median here is much worse than these numbers here or here. It's 70%. So net bottom line, we do see cracks. They're not in the important charts yet. What's going to happen next? Have no idea. Don't need to know. Just need to pay attention. If these numbers start to drop here in the next 2 to 3 weeks, the market model will have us incrementally reduce risk. How do we use the information from the previous table? We mentioned that we were looking at the correlation model. There's also inputs from other models. You can see here 1, 2, 3, 4, 5. There's 5 separate inputs that help us determine the most important thing, which is how much of my capital should I allocate to risk and how much should I allocate to more conservative investments. And you can see over the last week between Friday, October 25th, and the present day, the market actually improved a little bit as the S&P 500 gained. And thus, we have made no changes over the past week, nor have we made any changes over the past 2 weeks. If this number starts to drop, we're more than happy to make the necessary adjustments based upon observable evidence. If for some reason conceptually it's a little easier for you to understand bonds versus stocks instead of long versus short, you can see a similar analysis comparing 2011 and the present day either on Seeking Alpha. You can Google this title here, or you can find the same post on our blog, Short Takes. Short Takes does not require a login, and the vast majority of postings on Seeking Alpha, not all of them, you can find them here as well if that's a little bit easier for you. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.